Okay, so who do you have to offer coverage to? Anybody, full-time person is, in their term, anybody that works or is expected to work 30 hours a week or more. Now, they changed it from work 30 hours a week to provide 30 hours of service, because God forbid they give us any break at all. So 30 hours, what that means with service is that includes vacation time. It theoretically includes vacation accrual, although the regs are subject to interpretation on that. It includes people on FMLA or disability. And for this purpose, seasonal people do count. So once you determine whether you're over 50 or not, then it's a separate set of rules to determine whether someone's full-time for purposes of whether they individually count. So where seasonal kind of didn't count before, seasonal counts now, but there's a good faith rule and we can help you with the calculations and all that stuff. In 2014, to determine if someone's full-time, you look back. You can either look back 6 months, so the last half of 2013, or you can look back the entire year of 2013. That's your choice. And again, we'll help you with what makes most sense. After that, it's always a 1-year look back. If someone was generally working 30 hours over the course of the year, they're considered full-time. You could also do 130 hour per month if that helps one way or the other. When is an employee eligible? If somebody consistently works more than 30 hours, they have to be eligible within 90 days of date of hire. If they're sometimes working 30, sometimes working less, then there's this whole complicated formula that we can help you with that's this long, that basically to determine at what point someone becomes eligible or how long they stay not eligible for. Okay, so pick your penalty. This is what Christina referred to as either the 2,000 or the 3,000. Believe it or not, this is a case where 3,000 is better than 2,000. So if you don't offer insurance, this is what the geeks call 4980HA and 4980HB, what they've also referred to as pay or play. I don't like the term pay or play because it makes it sound like we're actually not doing our fair share and already offering insurance to employees, but that's what they called it, so I'll use the same term. So option A is you say, listen, we're just not going to offer insurance at all. If you don't offer insurance at all, and you're over 50 employees. If you're under 50 employees, go to sleep, none of this applies to you. If you're over 50 employees and you don't offer insurance at all, then the first time one employee goes to the exchange and theoretically qualifies for the credit, whether he takes it or not, you're now on the hook for $2,000 for every employee that you have that's full-time except for the first 30. So as a quick example, if you're a 100-man company and you don't offer insurance at all, or don't offer what they call minimum coverage insurance, then you'll pay $2,000 on all 70 full-time people, so that's $140,000 a year. Big number. Option 2, you offer coverage. It's considered not affordable because for some people it costs more than 9.5% of their adjusted gross income or their household income. In that case, you only pay for those people that are considered not affordable. They're making less, so it's more than 9.5%. B, they go actually through the pain of going online, going to the exchange, and filling out the 21 pages of paperwork. And C, actually qualify based on their household income and all these other kinds of things. So it's a much, much smaller number. Conservatively, so it's only the people actually receiving the tax credit in that situation. So conservatively, I said, if you have 100 employees, maybe you'll have 10 people. If you have 100 employees, you offer insurance, and only 5 people happen to take the insurance. Maybe they're the managers, maybe they're random people, but let's say only 5 people take the insurance. Well, you've offered insurance. Hopefully it's affordable to everybody. Maybe 10 people it's not affordable to, based on the math. And maybe all of those 10 people go on the exchange, they all fill out the 21 pages of documents, they all get their credit, and you're on the hook for all those 10 people. That's a lot of maybes. That 10, in my opinion, will be a lot less, so I think you're probably talking about 2 or 3, maybe 5. So now out of that 10 people, you're paying $3,000, that's $30,000. If it's 5 people, you're paying $3,000 times 5, that's $15,000. So by offering insurance and designing a way that it may not be affordable to every single person, all right, you're on the hook for $15,000, $20,000 maybe, as opposed to the $140,000 otherwise. And again, we'll help you with all that math, and it only has to be affordable for the cheapest plan that you offer. So what we would do is give you a dual option plan where you have the bronze package and the platinum package. You have this just to comply, and you have this for what the employees really want. So again, there's a lot of ways to, I don't want to say skin that cat, but there's a lot of ways to make the unpalatable a lot more palatable and not really break the bank. Okay, so reporting and compliance. A lot of things to deal with. We just talked about the mandate and the employer responsibility and all that kind of good stuff. So what we're going to talk about now, very briefly, is just all the stuff you got to do to stay in compliance, besides complying with the actual mandate. Number one, there's I call it a 5500 type of report. So if any of you have dealt with Marcia when she's doing your 401k plan and you know never to talk to her in the months of June or July, it's because she's doing all the 5500s and you don't want to be anywhere near her at that point because that report is a pain in the butt to fill out. Fortunately, we just do it for you. You guys just have to sign it and you're done and boom, your 401k is finished. Same basic concept here. There's going to be a report that's very much like the 5500 that for those tag clients, we'll just do it for you and get all the information. Fortunately, because we have your payroll information and we have your benefits information, we just can get it all together and just do it and say, okay, just sign here and then you're done. W-2 reporting, you got to report your actual cost of insurance, the employer contribution to insurance for all these different types of insurance, medical and Medicare and EAP and prescription, all that stuff. Again, since we have all that running through us and through the billing system, we just report that automatically on your W-2. It hasn't been mandatory yet, so we only are doing what the actual requirements are, but starting 2014 it becomes mandatory and we'll do that. Here's the fun thing, summary of benefit and coverage. So this is a big old pile of paper that you got to hand to every one of your employees and all their covered dependents, even if their covered dependents are a student out of college somewhere or a divorced or separated wife pre-divorce where you don't even necessarily know their address. You're on the hook to get these forms or get these packets to all these people, and it's your responsibility to know where all these people are and their addresses and keep up to date and all that kind of stuff. Again, Calvary's here. We're going to take care of a lot of that for you. We're going to create an easy way to help that. It's still your responsibility. We're just going to make it a lot easier. We're going to make it a lot more manageable. We also are able to email it to people in certain circumstances and all that kind of stuff. You got to hand this out 30 days prior to renewal and within 7 days of someone requesting it. As I mentioned, you got to track dependents that you wouldn't have any idea where the heck they are. And the penalty for not doing that is $1,000 per incident. And we're going to come in and help make sure that doesn't happen. Notice of material change, that's another reporting requirement. Anytime you make a change to the plan, like your renewal, 6 days prior, you got to send them a bunch more paper. Again, we're involved in that. We have to notify employees that these exchanges exist and they're available to them. Again, we take care of a lot of that for you. Summary plan document, you still have to provide summary plan documents, which is similar to SPCs, but why not have an extra pile of paper? Government loves those. So again, we get involved in that. If any of you have plans that you've had grandfathered since March of 2010, you have to send out grandfathered plan status notifications. I don't think any of you do that I know of, but that, again, is just another thing that goes out. Okay, so what's the market going to look like? All this is, everything I mentioned in terms of the mandates and probably more of the stuff that Christina mentioned are going to affect what basically the future of healthcare and health insurance is going to look like. So let's talk about it a little bit. Pricing. The insurance company can no longer price based on medical history. So they can't, as Christina went through the example, they have to give the healthy group and the healthy individual the same rate as the unhealthy person, which sounds great in theory, except that just means the unhealthy people or the healthy people are going to have much higher expenses. They're not going to sign up for the insurance, and you're going to have what we like to refer to in the industry as a death spiral. You have only the sick people signing up for insurance. The insurance companies can't recoup the cost of just covering sick people, and the rates go up more and more and more, which cause more otherwise healthy people to not take insurance. So there's only 4 aspects that insurance companies are allowed to rate on. Age, the maximum they can charge difference between the youngest person and the oldest person is a factor of 3. So a 20-year-old and a 60-year-old or 65-year-old, they can only charge a 65-year-old 3 times what the 20-year-old is charging. Right now, in most states, it's about a 5 or 8 times ratio, which again is good because that means that the 20-year-olds are actually signing up for insurance because it's affordable, where what this does is just young people just won't sign up for insurance. You can charge it based on their geographic area, family size, and whether they are tobacco users or not. You get up to 50% premium for that. As I said, no medical underwriting or re-underwriting, and rates are rate increases in the process is subject to review by HHS. Products. So the government has created the minimum essential benefit. It's 10 essential coverages, things you'd expect. It's got to cover medical, prescription, ambulatory, preventative. It's got to have co-pays, things like that. They all call that minimum value. There's no more for anybody in the hospitality business that where used to offer part-time people. Mini-meds, those aren't allowed anymore. So there's no catastrophic plans unless you're under 30, and even those aren't really catastrophic. And there's no more mini-bed plans. Maximum deductibles, $2,000, $4,000 for family. The insurance companies may get rid of the 100% plans in order to offer something that's affordable and still keep to that deductible. And the maximum out of pocket is going to follow the HSA, $6,200 or $1,200 for a family. Probably we think if you're over 30, no more HSAs or no more high deductible health plans because they're going to require a copay. The law on that is very vague and there's still going to be regulations come out. It's a 50-50 chance whether high deductible health plans, if you're over 30, go away or not. No lifetime maxes, so anybody on insurance could have $1 zillion of claims and there's no capping of the policy. You have to cover clinical trials, insurance companies. Through all that, if they happen on a bunch of policies, to actually still make a few bucks, they can't make more than, in your case, is 20%, including commissions and overhead and all that stuff. So the profit squeezed out, so that's going to affect the insurance companies. And with all that, the carriers are supposed to release initial plans in middle of March just to get people an idea of what some plans are going to look like. They're still waiting on some regulation, so that's probably going to be delayed. Okay, so I've scared the hell out of you guys with a lot of that stuff. I'm going to give you some good news at the end.